Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we are going to talk about monetary policy. Now, this is a follow-up video to a video we just released on fiscal policy. Monetary policy is really important because what central banks like the Bank of Canada or the Federal Reserve Board do from a policy standpoint can have a direct impact on our lives. Sometimes very subtle, which is usually the case, and sometimes not so subtle, which has been recently happening with economies in both Canada, the United States, and around the world. Now, fiscal policy was important, and I encourage you to take a look at the video. There's a link to that video in the notes, the show notes for this video, because it directly impacts our pocketbook. So governments will use the tax code, their power to borrow money, and then their expenditure allocations to try to influence the direction of economies, impact quality of life and opportunity for Canadians. And particularly when it comes to program spending and expenditures and taxes, how much they take out of our pockets, it has a direct impact. Now, monetary policy can be a little more subtle. So let's unpack that right now. Now, before we get into that, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of wealth planning, retirement income planning, not just on the financial aspects, but also on the non-financial. So you don't miss future content, hit subscribe, and you'll be alerted on future videos that we upload. Okay, let's lean into monetary policy. So what is effectively monetary policy? Well, monetary policy would be a set of policies that central banks utilize to affect the growth or contraction of economies. And principally, they'll use interest rate policy to influence that. Secondarily, central banks have a very big role in maintaining the purchasing power and managing the currency of the country and using interest rates to affect the impact of inflationary pressures on economy. So when it comes to interest rates, based on where interest rates are, it can affect people's savings patterns. So if interest rates start going up, you'll see flows of money to fixed income investments. People are incented to put money in savings accounts or guaranteed investment certificates. And when interest rates are really low, they're incented less to save money and potentially in aggregate to spend more money because the costs of borrowing are lower. It'll encourage spending in terms of taking out mortgages for real estate acquisitions or consumer goods as well if rates are low. So central banks will use interest rates to begin providing incentives for the population, organizations, corporations, governments to make certain decisions in aggregate based on where interest rates are. So if you want to expand the economy, you'll tend to push interest rates down. And if you want to contract the economy because you're concerned about inflationary pressures, you'll tend to increase rates, which will potentially reduce spending. So as I mentioned, one of the key priorities for central banks is to manage inflationary pressure. So if you don't manage it effectively and let it get out of control, it can be very destabilizing for the population and for the government that might be in power and can lead to some really negative ripple effects. So if you're in a situation where you're seeing, inflationary pressure going up at 7 or 8% per year, and the average increase in wages is, let's say, 2 to 3% per year, then the average person is losing purchasing power. They're not staying in pace with inflation. Their dollar doesn't go as far. And you begin to put pressure on families, on local communities, on the tax base. You put pressure on governments in terms of having to increase their expenditures for social services and other programs. So from that perspective, it can be very destabilizing. Then on the other hand, if you saw a deflationary environment where the costs of goods and services are going down, it creates the opposite problem. So in a place where inflation is going up, people want to buy quickly and get their goods or services before they go up again in price. In a situation where you see the cost of goods and services going down, it's called a deflationary environment, then people begin to defer those expenditures. And that actually acts to perpetuate further slowdown in the economy. So the central bank's role is to try to mitigate against those two extremes. What they're shooting for is a moderate rate of inflation. It's kind of like the Goldilocks theory of inflation. And so if inflation's averaging, generally speaking, 2% per year, that's considered a good level of inflationary pressure. It's not too high, it's not too low. You're seeing overall growth in the economy, overall wealth creation, and it's a manageable number that governments and the society in general can manage through. And so the central bank will use, interest rate policy as an example, money supply policy to kind of moderate the effects of those inflationary pressures. and to keep in that Goldilocks zone of inflationary pressures. Some other terms you often hear with regard to central banks is expansionary policy or contraction policy. And again, they'll use interest rates as one tool to try to either help the economy grow or to slow it down. Now, central banks will also initiate these policies in the context of what our government's doing. So we talked about in the previous video on fiscal policy how governments will use, the tax code, the powers of borrowing, or their expenditures to influence employment and opportunity, productivity in the economy. And although theoretically central banks are to be, independent of the governing party, obviously they will take into account the current policies being used by governments. And so if governments are initiating policies that could be effective and in line with the central bank's policy, that may allow central banks not to increase rates in a situation where there's inflationary pressure, because maybe governments are initiating policies that would help to mitigate those pressures as well. So when it comes to the central bank's role, it's really obvious right now. And so in this environment, at the time that we were doing this video, there was a lot of inflationary pressures, some of which were due to, I think, COVID. They were a unique set of circumstances where we saw the lockdown shutting down big parts of the economies around the world. We saw supply chain interruptions where, manufacturing, the supply of goods, that whole system was broken. And then we saw the opening up of economies, people spending money again and wanting goods and services, and you had too much money chasing too few goods, and that led to inflationary pressures. The central banks, like the Bank of Canada and the Federal Reserve Board, have been trying to find this sweet spot in that they do want to increase rates, and they have, but they don't want to increase rates so quickly that they actually throw the economy into a recessionary cycle. And so it's a very tough thing for central banks to get right, because we're talking large economies. It's kind of like these large, cycles of economic growth or economic slowdown. And so they try to initiate policies that impact it, but it's very difficult to get perfect. And certainly we're going through that period right now. Now, another strategy that banks will utilize is something called quantitative easing. So if they don't want to directly impact interest rates through what's called their overnight lending rate, they'll engage in using their ability to basically print money and then using that money to buy assets. So as an example, they might buy assets in the bond market or other financial assets to provide liquidity to help provide economic growth and stimulus. Angelo Molino, an economics professor at the University of Toronto, says to implement QE or quantitative easing, central banks look at their willingness to introduce liquidity or add more money to the economy. And when buying bonds and other securities, central banks must explain what they expect to happen to the target interest rate in the future. They also have a plan on how they'll sell those bonds and securities when they stop using QE. And finally, sometimes when it comes to central bank policy discussions, you hear the word hawkish or dovish. So the central bank would be hawkish if it's pursuing policies that constrict the money supply through things like raising interest rates to curb or slow down economic activity. To be dovish is to pursue policies that will enhance economic growth, which could be cutting or pushing interest rates down, and also engaging in the policy of quantitative easing, where you're increasing the money supply. So that's my little review of monetary policy. It goes hand in hand with the discussion on fiscal policy. These are two really important areas that, as retirees or people managing wealth, you need to be somewhat conversant with the topics. You don't have to be an expert, but when you hear the topic bantered back and forth when you're consuming media, then having this background information might prove to be helpful. Now, if you are new to our channel and you're not subscribed yet, make sure you do that right now so you don't miss future content. As well, if you're looking towards retirement, if you're already retired or thinking about retirement and you want some guidance in the area, there'll be a link that'll take you to our web page that talks more about a retirement income planning service. Anyway, wishing you all the best in your retirement and wealth planning journey. You take care.